Ready to start.
Yeah, well,
Perfect, guys. Happy Saturday, good afternoon. Happy Sankranti, happy Pongal, Lodi to everyone who's celebrating those festivals today. This is Sudhir here with Yash. Welcome to Miramar webinar. Especially being us, many of them being Indians here. I mean, Saturday is very special to us. So thanks for spending your time with us this afternoon to learn about investments into our next project, Miramar. Am I audible, and are you able to see the screen?
yes, Sujay.
Yes.
Perfect, then. Let's move on. A standard disclaimer before we present any project to a large group like this. This is a 506B syndication, and it is open to investors with pre-existing relationship with sponsors and as well as co-sponsor. So I believe everyone on this call might have some kind of a relationship with us and in some shape and form. So as you can see, I mean, me and Yash are the lead sponsors on this deal. I and Yash have worked on several different types of real estate investments. We both are really proud of what we have done with community investments into Namma Bhumi and other investments into various apartment complexes. We both have actively worked on several single family assets that crosses over $10 million in net worth. And apartment investments are not new to us in any way, but this is our first deal where we are leading a multifamily investment. Moving on this deal, we have a co-sponsor, Ranga. He has been a good friend of us, and he is an aspiring lead and is supporting us on this particular project. So now let's begin. I mean, we are here to talk about Miramar. So Miramar is a well-maintained Class B apartment complex in southwest part of town. For people familiar with Chinmaya Mission or Krishna Vrindavana, this is a complex that is very close to that particular area. So talking about the location, this is just an amazing location. It's right next to schools, churches, temples, close to major highways and several major employers. So looking at this particular location, yeah, I mean, major employer being West Chase Business District, about 10 minutes from Sugarland. Another major employer out there is Energy Corridor, right across, about 20 minutes from the property. And yeah, again, 30 minutes from downtown Houston. So pretty good location to begin with. Now, looking at the property overview, it's a vintage 1984 built property with 11 buildings and 143 units. The property has typical amenities for this class in that area. A few things to mention are, this is not all bills paid kind of a property. The electric is individual. RUBS is implemented by the previous owner for water. It is located on the city bus route, which typically helps the blue collar workers access the metro. And other amenities that are part of this complex are pretty much it has a gated access picnic area with barbecue and the general things that you'd expect from a Class C type of a property. Looking at the unit overview, modern amenities are available for each unit. And our plan will be continuously improve the quality of living for our residents by implementing rehabs with unit turns And one of the coolest amenity that is rare for this type of class is a washer dryer connection in each unit. And this is one of those complexes that has those connections available everywhere. And other things that are again typical is a fully equipped kitchen, comes with a refrigerator, individual AC, of course ceiling fans, private patio, and solar screens. Now Miramar has 6 different floor plans, ranging from 650 square feet to 1060. And as we move along, as you can see here, two tables. One is the scheduled rent grid, and that rent is being collected by the complex today, $7,000 on a monthly basis. And year one, we are looking to increase it by 4%, taking it to $133,000. And this is with our plans to rehab the units when they turn. When they turn, as in when someone moves out, we are going to go in and rehab those units. So to give you a good glance of the rent comparables in the area with what we are looking to increase, we are trying to get this one to $11 per square feet. And if we look at the numbers as is coming from CoStar, 17 comparables that we have out there is already generating $9. I just wanted to share this report as is without skewing any part of that particular data. I didn't want to show you all what is favorable or not, but this is as is data. So we are looking for a small increase in rent to hit our rent pro forma. So here comes the high level investment summary. So as we said, I mean, it is 143 units that are available. It was built in 1984. We are purchasing it for $14 million. And I have a rehab of $1 million out there, but those numbers are not fully finalized yet. We will have those things done in the next few days. But we'll be somewhere in that $800 to $1 million ballpark in terms of what we look as a rehab budget. And in terms of loan, we are getting a loan of about $12 million with a loan to value ratio of 80%. We are looking to raise $3.8 million, and our interest terms are interest only, right at around 3.5% interest rate. It's a variable interest rate, so we will be capping our increase by pre-purchasing the interest rate cap at closing. Now, moving on to financial information, we are looking at an investment of $25,000, which is a minimum investment. But as you might have seen, sometimes these deals get oversubscribed, and when they do, priority will be given to large investors so that we can keep the list with what is needed as part of the syndication. So in terms of revenue sharing, we are going to do a 80-20 split. In terms of cap rate, we are entering it at 4.2% cap on a T12. But if we look at the last 3 months, which is called as a T3, we are entering it at 5.5%, which is a good entry rate for a building of this size. And in terms of exit cap rate, again, for the investors, in terms of what we think as returns, we are looking to exit at 5.5%. Now, looking at the returns projection, we are looking at a total passive return of 100% over 5 years. we have locked in a preferred return of 8%. We are looking at depreciation of 75% of your investment at an average annual return of about 20%. Now, I mean, as we start looking at the numbers, one of the things that we want to do is, I mean, whether this deal with what we are paying hits the stress test financially, whether it hits it. So we put a few different criteria here. Basically, we want the complex is occupied right at around 95 to 97% now. So for us, the break-even occupancy to service our debt is 75%. And before I go into DSCR, DSCR is a term, it's a ratio which indicates that the company is generating sufficient operating income to cover its debt and interest payments. So basically, you should be able, if it is 1, we are making enough to cover that debt. So anything over 1 means we have a little bit of buffer out there for ancillary expenses or for returns. So the second criteria here is about vacancy shock. What if it drops by 20% from year 1 to 6? Again, looking at it, we are going to make $1.27 to 1.47 from year 1 to year 2. The deal still continues to cash flow, even with 20% vacancy. Now, we did one more scenario here, which is if we take in 15% less than what we take in today on the property. So if we take 15% less, again, we are going to be okay with our DSCR, wherein it will be 1.05 and year 2 1.04. And the last but not the least, it is status quo. I mean, don't make any changes, run it as is. Again, we'll be in the range of 1.1 to 1.3, and the deal will continuously cash flow. So we did some stress test here, and we feel confident that we should be able to return our investors a decent cash flow and a great return at the end of this project. So moving on, I mean, we talked about the return, right? We said, like, I mean, yeah, we are going to give you 20% return or like 100% return over 5 years. But in multifamily, there's always a range, and that range is based on how are you exiting this particular project? What cap rate are you going to exit? So we feel based on the compressed cap rate that is happening in multifamily, when it's time for us to exit, the best case that I can look for, even lower than this is great, but best case based on what I feel is going to be somewhere here, which is going to return all of us at 26% on an annual basis. And what we put in our return summary, if we exit at 5.5, we are going to make 100% return at 20% per year. And in our worst case scenario, we are going to exit at 6% cap, and this deal will generate 15% annual return. So as you can see, there is a little bit of variance here, but we wanted to provide you that transparency based on the exit caps. Moving on. So this is a high-level capital expenditure budget. There are 2 sections here. One is the interior rehab, wherein we have put a conservative number here, and we are going to spend about $4,000 a year with moderate upgrades to each of these units. So we're going to make some slight changes to the countertops. We are going to refinish the cabinets, and we are going to add some new flooring, lighting, and appliances. So some of these things will again change based on the condition that we are going to turn each of the unit that is out there. And in terms of exterior rehab, every 3-4 years, the paint fades away. So we have kept some budget for exterior painting. We have kept some budget to do refacing of the parking lot and foundations. And we are going to do some pool repair. And we are budgeted to replace about 40 units, 40 AC units. Again, think of this as a budget that is available for us to do all of this work. Again, we are going to be smart about where we are going to spend these dollars so that it in turn increases the quality of living for our tenants, and also increases the net return for all of us. So that is the plan. We have some ideas to go look for washer dryer rentals. They are not explicitly specified in the CapEx, but they are available in the expenditures so that we can use it wisely. Moving on, this is our 5-year roadmap in terms of how our cash flow would end up looking. So the first column here is our T3 as is, as we get it from the current seller, $782,000. The first year, we are not gonna look for a huge change in that NOI because we are gonna be looking at rents to increase value. So we are gonna be looking at close to $800,000. But the third year, which is the second year, which is going to be our year of rehabs. So that is the year where many of the leases might turn, and we are going to be doing those rehabs, and we expect the rent to dramatically go up and our NOI to increase in year 2. And beyond that, year 3, 4, and 5, again, you can see a nominal increase that is happening between 3, 4, and 5. So in terms of rehab, this is some of the current rehab pictures. Again, we are not going to spend a whole lot of dollars on these rehabs. We are budgeting right at around $4,000, so we can get a whole lot of these things done in our rehab budget. So, and some of the exterior work that is already done on the property, but we are looking at improving the parking lots. We are looking at improving the pool, wherein it might need some replastering, resurfacing, things of that nature. Now, looking into the numbers all over again. So we are purchasing it at $14 million. We have budgeted about $1 million for rehab. We are going to get a lender financing of about $12 million. And the equity raise that we are looking from the investors is $3.8 million. So the numbers are broken down here with our down payment being right at around $2.95 million, closing costs at about $510. We'll have some money in the escrow, and we'll have a working capital of $200,000. Again, these numbers will slightly change as we continue to work with the lenders and finalizing some of those rehab numbers. Now, looking at the investment and what that investment is going to do for us and how we are thinking of returning that investment back to you. So typically, year 1 is a slow start. We are looking at returning a dividend starting in the second quarter. So that puts us at about 6% return. Year to year with increases to rent and all, we are going to be looking right at around 9% return. Year 3, we are going to increase it to 10, followed by 12 and a 10 again. Year 3 is a place where we are going to be looking for a possible refinance. And if we do this refinance, we are going to be looking at an opportunity where the cash out refi is going to return a good return to our investors. And when these things happen, there is always a small cost that will apply in the chance of a refinance. And the typical fee structure here, we believe in returning more money back to the investors. And so we are going to be doing the 80-20 split without a whole lot of added fees at closing. We strongly believe in this asset, and the sponsorship team is looking to invest more than $500K of the $3.8 million raise. So we will be doing more than 10% here in terms of that investment from us. And we are going to be charging a 1% acquisition fee with a 2% asset management fee. And we are going to be using a third-party management that will be charging us 3% to manage this property. Coming down to acquisition timeline, we are right here. We have completed the due diligence. And from here on, we are going to be looking at raising the funds. We expect the subscription to be fully closed by February 15th. And our target closing is right around the March 1st. Again, things can change a little bit. We have until our contract, the way it is, we have until end of March to close this particular property. So basically, how to invest. If you are ready to invest, anyone investing in this deal has to have a pre-existing relationship with one of the sponsors, as I specified earlier in the disclaimer. Please review the offering, and there's a link down here to review the offering. Create your investment profile. Complete the paperwork as soon as you can, and fund the project. We are going to be accepting IRA funds into this particular deal. So please talk to your IRA administrator. Moving on, post-closing reporting. I mean,
Sridhar, sorry to interrupt you. Just a quick question. As they are on the investment side, are we also accepting 1031 exchange or not at this point? No, nothing. Just asking.
They will not be accepting a 1031 exchange on this one.
Okay. Yeah. Sure. Thank you.
So essentially, I mean, yeah, of course, we'll be sending monthly reports. Expect regular updates from us. We are conservative here again. Expect the first distribution after 6 months, and quarterly distribution after that. Some aerial pictures of the property. And I want to thank you for your time. Please contact us if you have any question. And now we'll open for Q&A. Yash, how do you want to handle the Q&A?
Yeah, first let me read few questions that is posted on the chat. The first question is, what is the current occupancy rate?
It is 97%.
And Prathamesh asks, assume that I know his question, but I will keep this at the end because I do not want to confuse others who are here for the first time.
Okay.
But one question is, what is going on in cap rate on 2019 numbers?
2019, this was capping at around 6%. And now it is capping right at around 5.5. Is that your question?
Yeah,
Feel
I
free
think.
to unmute and ask.
Yeah, Prathamesh, you are welcome to ask that. But be careful, not. I do not want to confuse others about the previous exit in this talk. Huh?
Okay.
Let's keep it at the end, please.
No worries. Then actually had a few questions, but I'll not mix them
Anything
up.
related to that, let's keep at the end. I do not want to confuse.
I'll not
the
ask
first
anything on those things. Yeah, I think I was just trying to understand what the going in cap is. If we all assume we'll stabilize on 2019 numbers at some point. So you're saying around 6%, and we are saying our exit will be 5.5.
Correct. So we are going in right here, 5.5 on a T3. And we are going to exit at 5.5 as well.
Okay.
I'm sorry, this is Amit here. I'm new to this. Can you help explain this T12, T3 cap rate a little bit more? And if you think, this is not, like this is a big forum and this is not something worth time of everyone, we can talk offline as well. Just wanted to understand this a little bit. So I'm open to save time for everyone, if this is on the right forum.
So
And I have the same
I'll
question
explain.
too. This is Bhavin. I have the same question as well. Like being brand new on this entire thing, it's difficult to understand these acronyms. So it's better to get a little more helpful.
Perfect. I mean, I'll explain the two things are pretty simple. T3 means the last 3 months of the revenue that is accrued by the property, which is essentially the last 3 months of the rents that they have collected. And T12 means the previous 12 months. So whenever we are going to be buying any apartment complex, it is based on the income that particular apartment complex generates. So T12 gives you some historical information, and T3 provides you that guidance. And cap rate, probably that is going to be a long answer. So probably please reach me after this or schedule some time and I'll go over the cap rate with you.
And Mr. Joshi, can I finish up with three questions I had? I think
Sure.
I just don't want to keep jumping in. Is it okay?
No,
Go ahead, Prathamesh.
Yeah, please. So the other thing I was trying to understand was, are you assuming the existing debt or this is new debt?
This is a new debt.
It's new debt?
Yes.
And what's the rate we are looking at?
3.5% variable interest rate. And it's IO only, interest only loan.
Yeah. And when you say 3.5 variable, as in it's like L plus something?
Yeah, it is based on SOFR, and we are gonna buy an interest rate cap when we close. So we are gonna buy that interest rate cap as part of our closing fees.
So the cap is going to be 3.5.
Correct.
Okay.
The higher ceiling will be 4.5, but we are based on the historical rate of SOFR. It has not moved much. So we are going to buy a 1% interest rate cap. So the max it can go is 4.5.
Max it can go is 4.5.
Correct.
Okay. So it's not a 3.5 strike. Okay. And got it, sir. And again, I think we can just generally to understand how will the distribution waterfall work? Where does the pref stand?
It is 80-20 split.
No, as in say you have distributions tomorrow, or say 1 year down the line. right?
Mhm.
So the pref is, so the first is how will the cash flows be allocated?
We are allocating 8% as the preferred return.
So first the pref gets paid before GP?
No, there
Right.
is no. There is a straight line between 80 and 20 between LP and the GP split.
So basically, if you have excess cash, you'll go ahead and pay back the capital?
No, I don't. I'll
Now,
not say.
Sudhir, can you go to the tab of that interest distribution, 6%, 8% in the last but one page? Yes. So generally, the distribution will be based on this table. But what the 8% preferred means, let's say in the year 4 or 5, we have not paid that much. The investors will be, even before GP gets, they will be still paid to add that up to 40% in 5 years.
So Yash, all I'm trying to get to is if I'm the LP, for example, or all of us as a team,
Right.
and if you put in X dollars, is any of your distributions paying back the capital? So 8.8% pref or 8.5% pref continues to be on the initial capital, correct?
Yes.
Okay, so you're not paying back any capital.
We are
And-
paying capital only at the either at refinance or at selling. The 8% preferred means a minimum of 8% will be paid regardless whether we make money or not. You are right. GPs may not even make money if you cannot pay 8% minimum.
Okay, so if you never have any cash flows for 5 years on exit, the waterfall, the way the waterfall will work is all the accrued pref will be paid first.
Yes.
The capital will be paid back first to the LP,
That's
and then the pref.
first the capital, then the pref, and then the GPs in that order.
Okay, then the GP. And
The
then
LPs are always.
GPs
gonna
at
be
the
given
end.
the
If there
8%
isn't any money, GPs won't get anything.
okay, and then the 80-20. Understood, sir. And if one other thing, I think you showed us some pictures, and so is maybe it overlaps with the other deal, so I'll just leave it out. So is GP contributing capital?
Yes.
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 We have to for all this indication. That's the lender's requirement.
So
because when I add your purchase price 14, rehab one, that's 15, we got $12 million finance 3.8, so that's 15.8. The 800 goes towards the working cap and escrows and other closing costs. So is the GP contributing in the equity raise amount?
This rehab amount is included as part of the loan. And those numbers, the dollars are released as we complete the rehab directly from the lender. If we don't use it, we don't pay interest for that $1 million.
Got it. So it's line of credit kind of thing.
Correct.
Okay. No, all I'm trying to understand is I think the deal has excess cash here.
It does not. Okay. I mean, yeah. Now, are you clear with this $1 million out of the question? Do you think the numbers work for you?
So 14. So you're raising your capitalization is 15.8. Purchase price is 14, right? So we have 1.8 million additional, right?
I think, did you count this closing cost, escrow, and working capital?
Yeah, that's that adds up to 840.
Okay.
So the purchase price is 14, financed is 12. So 12 plus 3.8, that gets us to 15.8. In this 15.8, there is $1 million rehab as well.
Correct.
But that
correct.
$1 million rehab is part of the 12 million, right? You said it's
Correct.
part of the loan, right?
Correct.
So I think maybe I'm not understanding clearly, but I think the question he's asking is that this 3.8 that is there, is it inclusive of the money that GP will be putting, or is it just the LP raise?
Yeah, this equity raise is not only raising from all of you. Out of this $3.8 million, we are going to be investing about $500,000 of our own money. So the total equity as such that is going to be available for this project that we are going to raise from you is roughly $3.3 million. But when it comes to equity that the bank understands, they want to look at this as a total equity coming onto the project.
Okay.
So there is no additional money outside of this $3.8 million.
Got it. Got it. So $500,000 is GP and 3.3 is LP.
Correct.
Yes.
So,
No. When it comes to dollars invested, GP's dollars are not any special. They follow the same nomenclature or the same return when it comes to the preferred return and stuff. They don't follow any special guidelines.
okay.
What is the eligibility criteria to get as a GP rather than an LP?
That is a hard question to answer in a large call. Please call me or Yash maybe after this, and we'll try to help you with that.
Yeah. Only if Mr. Joshi and Yash like you, that you get it on the GP count. One other thing, if I may just one last thing. I have few questions that overlap, so I'll avoid it. So who will be asset managing and who is the property manager? Is it the existing property manager or a new one?
We'll be using the existing property manager, Q10.
And the fees and everything line up with what these guys were paying?
Correct. We are going to pay them 3%.
Okay. And from the asset management front, who will be asset managing it?
It will be me and Yash.
Okay. Got it. Okay. Thank you, sir. I'll wait till the end.
Yeah, good question, Prathamesh. But the numbers are clear for you, right? That it added up for you ultimately?
Yeah, not 100%, but I think I generally understand. We can dig in details.
Okay, I want to be clear on that one. It's very simple. If you understand, Prathamesh, let me see how much money is coming in. Sudhir, let me explain because I want it to be clear for everybody. The purchase price is 14 million. Okay, we have to give $14 million to the seller. We need to allocate $1 million for the rehab. And below there is 500K closing cost, escrow, and working capital. That adds up to almost 850, right? So that comes to almost 15.8. Okay, this is going to be our total cost. Where is this money coming from now? So $12 million is coming from the bank. Okay, and $3.8 million is coming from the capital raised.
Right. Okay. The source and user match up. That's fine.
That's right.
Okay. That 1 million rehab loan and equity, I think that's what created this.
The reason we're trying to do that is we don't have to pay any interest until this rehab is done. So that way we pay interest on this. That was one of the smartest way we try to do it.
Correct. That's just
so that way our investors' money get better return.
Right.
Okay. The next question is current rehab pictures. Is the current owner already improving this property? I think Sudhir.
Correct. So let me go back to one of the slides here. So those are the current pictures from the current seller. As you can see, there are about 10 properties or 10 units that are already rehabbed. And our budget does not include that. So, but we are going to be looking at doing the others as part of our business plan.
Okay. what are the total costs and expenses associated with this project? What are the total cost and expenses?
Total cost.
I think he's talking about the closing costs.
Yeah, are you all talking about closing cost?
Naveen, you can unmute and ask the question if you want. Yeah, it is written here, but I do not know what else he wants to know. Okay. What is the
so
difference?
basically, I mean, I will explain you all in a nutshell, I mean, where the money is going and how it is going to be spent. So basically, there is a 2% cost with the lender and 1% is the acquisition cost. So that is about 3% that goes out. And the remaining is we'll have to pay an appraisal fee. We'll have to have prepaid insurances. We have to pay attorney fees. So things of that nature.
And
So-
also it includes some taxes for the
Correct.
this year, which is huge amount too. Okay, what is the difference between asset management fee and the property management fee?
Okay, the big difference is the property managers are out there to manage the tenants and manage the day-to-day issues that come with the property. So they are there to essentially do the day-to-day operations. The asset managers, on the other hand, are looking to optimize the property in terms of improving the operational efficiency, looking at the current contracts in place, improving on those contracts, and things of that nature. So they are there to hold the property management team accountable to improve the efficiencies of the property. So this is not a day-to-day kind of a job, but this is more like a week or week, at least in the beginning, and then on bi-weekly, so that you can look and optimize those efficiencies.
Is there a fee or a dollar amount allocated for the asset management?
Pardon me?
Is there a fee or a dollar amount associated with asset management?
It is a fee, it's a percentage, it's 2% of the income generated by the property.
And when do you get that? Every year?
It is probably, it's paid on a quarterly basis. No, I mean, it can be taken on a monthly basis or on a quarterly basis.
Even after 6 months or from day one?
No, it is
It is
from-
generally paid by the property management company. All these accounts are managed by property management company, and we are yet to see their agreement. And even though we are the sponsors or the owners of this, I don't think we can make those decisions just for this one. I'm sure there are some set aside rules for how to manage this. We do not know that yet. We are yet to see the agreement.
Okay.
It's
So
2%
that basically
of
comes
the-
out of the rent generated every.
Correct. It's 2% of the rent generated.
Okay. And then the 1 million rehab, you're going to set aside and you're going to start using it. And to manage that, is it part of your asset management or is there a separate fee for that, for managing the rehab?
There is no separate fee for managing the rehab. That is part of asset management.
Okay.
What is the last day for funding?
We want the funds to come in as soon as possible, but absolute last date is going to be February 15th.
How will you mitigate interest risk to this property, especially during refinance? Mitigate. Sudhir?
Well, I mean, we have a 5-year interest-only loan to begin with. That's what I said. I mean, like when we go into a refinance mode, we will, where did that slide go? We will look at what is going to make sense for all of us, right? Again, it's our investment that we want to make sure we return profitably out. So we can continue with the IO terms without having to do a refinance at all. But if an opportunity exists or comes our way where if the refinance is going to generate enough cash flow for the investors, then we would we'd make a decision and essentially get a refinancing done. But we will not do a refinance just because that opportunity exists. We want to make sure it helps us in returning more equity back to our investors.
Yeah, just so that we will be sharing this recording, and also this PPT, the presentation deck is already on the link I shared. When you, even before you sign up, you can download it from that link I posted already in the group. The next question is, when was this property previously sold and sale price? What is the expected future sale after your rehab completion?
Again, I mean, I would have to go with the long-winded answer there. The property was bought by a good friend of ours, Rakesh Bansal. Probably some of you have invested several times with Rakesh. He took the risk and bought this property during COVID times when the occupancy was low. So he bought it at a very good discount. He bought it at 70K per door. And we are buying it at 97K a door. The future as such in terms of CoStar predicts somewhere in the $120,000 range in 2025. But I mean, again, I mean, if you know the future that great, right? I mean, we'd all be a billionaires, but all we are trying to do is we are projecting based on the income this particular property can generate for us over a period of time. So we strongly believe based on where this property is located and what kind of people live in that particular property and what are the possibilities about increasing the rent to an extent, we strongly feel that we will be able to exit in about 5 years at roughly $18 to $19 million. And that number will help us give everyone at least a 2x return.
So if I may ask on the same line, since you were talking about the prior deal, so any specific reason for them to exit now versus later?
Well, I mean, today is always cash. So we were looking and we had underwritten several properties, and we happened to meet for lunch with Rakesh, and we were sharing some of the work that we had done with him. And he said, I mean, hey, if you want to look at Miramar, I'm looking to sell if it is going to be the right price. So, and then we went and looked at the numbers and all, and we felt comfortable with those numbers. And that's how the transaction happened. This never really came out into the market saying that, hey, I'm trying to sell. This was more like a true off market where like a conversation ended up in us agreeing to buy it.
Okay. So the next question is, asset management fees goes to GP.
It is basically lead sponsors. It goes to lead sponsors, and lead sponsors will have a discretion of how to distribute that to a general partner. Is that? Yeah, I think that's what the question intends.
Mhm.
So there are two things that happen here. Okay, I mean, a general partner works with a sponsor. In this case, me and Yash are the sponsors of this deal, and Ranga, our good friend, is a co-sponsor or a general partner. So the agreement between us is confidential, and it is up to the discretion of a lead sponsor to provide some kind of a return to a general partner. It need not be paid, but sometimes it gets paid based on the amount of effort and all a GP provides to a particular deal.
What about the property taxes and how it is going to be handled?
Generally, property taxes always increase a little bit, as we have seen with our primary homes as well. And we have budgeted for that increased property taxes as part of our operational budget for future years. If you have anything more on that, please ask.
Is this the first investment by Namma Partners as a GP? If so, how confident are you to pay the role of the asset management?
See, Namma Partners is, we started Namma Partners only last year. In my journey with multifamily started in 2016, 2017. And I have GP'd at least 7 different deals. And Yash, from what he has done, he has also GP'd or co-sponsored enough of these deals. Now, when it comes to being a GP, you are working hands-on with the sponsors. So in terms of an experience, yeah, this is the first one where I will be making lots of those decisions with collaboration from Ranga and Yash. But in terms of experience, yeah, we have had enough experience in terms of playing that role of an asset manager. So, I mean, to put some numbers in perspective for some of you, we currently in our portfolio, we hold more than $10 million in assets that we manage. And for us, that operational efficiency is always a key thing. And you have seen Yash, right? You're asking for your W-9 and verifying your investments and all. That is all a key knowledge that is going to be needed to meticulously maintain the property that we are going to manage. But yeah, we believe we have enough experience, but always there is that first time, right? That's why the standard disclosure. This is the first time leading a deal by ourselves.
Do you have your own construction team to work on the rehab?
No. Again, I mean, commercial construction is a slightly different kind of an animal. If you know Lifestyles Unlimited, I am part of Lifestyles, and I have a strong team behind me to help with every bit of the operations that come our way. So we are using for all of the construction work that will happen here, we are using a company called Legend Developers. So they are going to be doing majority of the rehab work, and that will happen on the property. But when it comes to some of the interior unit turns, we are perfectly capable of handling those unit turns.
So the general contractor you spoke about is unrelated party. It's a third party you've done work with before.
Correct. Yeah, we don't have any relationship other than them being part of Lifestyles Unlimited, and any work that we do out there, we don't get any fees for the work that we end up doing on this particular property.
Sure.
Again, for me, I want to make one thing super clear as such is, for us, being the asset manager is optimizing. The more optimize, the more return I'm going to generate on this particular project. So that is going to be the key for us in terms of running this property efficiently.
Will you be presenting this to other potential investor group? We do not know yet, but this will be clearly first come, first serve. We will be, today, we had, there was a limit on number of people who can attend the call today. It was 100. And we had 99 people attend the call at some point. And so it was totally full. And I did get a message from 3 others saying that they could not register, which was too late. So we had full capacity today. I hope people will subscribe, and if it is full, no more presentation or anything. But if we need, we may present one more or 2 more, whatever is needed. What is the turnaround time to rehab one unit? So that
the turnaround time is probably 3 to 5 days, depending on the type of unit. If there is a hoarder living in that particular apartment, that might go up to 2 weeks. But generally, these are small units. It should be a quick turnaround.
I have a question related to GP and LP payout upon exit. Also, how is the investment by LP is secured? For me, all the LPs are the members of going to be of this LLC, Namma Miramar LLC. So you are all the partners of the company. The company owns the property, and all members are the partners of it. That's how it is secured. Question related to GP and LP payout upon exit, Sudhir.
At exit, it's going to be the same. I mean, basically, we are going to be paying that 8% preferred return first. Once that 8% preferred return is paid, the remaining dollars are going to be split 80 and 20.
After paying the capital.
Yeah.
So Yash and Sudhir, the main question is related to, is 20% targeted return over the years? So let's say 2 times 2x upon the exit. Is it guaranteed or secured? And anything above that is further distributed between LPGP, or 20% per year is not secured, is just illustrated or targeted or something like that?
So one thing I want to really clarify is there is no guarantee with any returns that are mentioned today.
Mm.
This is basically a pure pro forma based presentation that we have done based on our analysis of the data that we have available and the projection that we have made based on the current market conditions. So that's why a few things that we shared early on in here was around the exit time. I mean, we did not want to tell anyone here that we are going to guarantee you any amount. But we think we have a sense wherein on the worst case, we will be able to return around 15%. And on the best case, we will be able to return at around 26%. but we are projecting that we should be able to reasonably return 20% return back to you. But that is again a projection. All of these numbers are projection. We strongly believe we'll be able to achieve it, but there's always like another COVID, another thing that we might not be aware of that might be coming our way.
No, that's understand. So one last question. So the property today is class B, right? Because of the number of years it's in exiting into the business. So by the time our exit strategy of 5 years, would it be still considered as class B, or would it fall under the class C category?
It is, I mean, like we are classifying this as a class B, and I think it will continue at that same level. See, the more work that you do, I mean, there are different classification people go with, B plus, B minus and stuff.
Yep.
Again, the more work you do, the more amenities that you provide, the cleaner you keep, it gets a better value. So by the time we exit this particular project, it is not going to be a C for sure, because we have prepared ourselves to put substantial dollars into this particular complex to keep it at the same class or improve the class.
Okay. All right. Okay, thanks.
So is it standard practice to sell in 5 years?
There is actually nothing standard in terms of selling at a certain period of time. There are some operators that have held for more than 10, 12 years. So when you hold those for that period of time, at around roughly 3, 4, 5 years time frame with the cash out refinance and stuff, most of the money gets paid back to the investors that are on the deal. After that, it's basically passive cash flow coming to the investors. So there are some people who like that model where all their money is out and there is a lot more income coming into them, and they have kept it. But in a presentation like this, generally our time horizon is roughly about 5 years. We can think in terms of that 5-year plan, wherein like what would happen in the next 5 years kind of a thing. That's why these are projected right at around 5-year plans. But the whole typically can be anywhere from 3 to 6 years with slight deviations. But we'll talk about it when it comes. But I strongly feel that we will be in this project for that 3 to 5 years time frame, and exit to go do a larger investment.
What is the per year rate of return for LP? Okay, he says his question was answered. Is this a recourse loan?
It's a non-recourse loan. It's an agency non-recourse loan.
All right, that's the question in the chat window. But are the distribution annual or quarterly?
We will be doing a quarterly returns. The first one might come at the end of the second quarter. But other than that, we will be doing a quarterly return after that.
Okay. So that's all the questions I see on the chat. But if anybody wants to unmute, raise your hand and I can unmute and you can ask some questions. We have kept more time for the question and answers. Raise your hand, unmute, and then that way only one can ask the question. I don't see anybody raising hand. Anybody welcome to unmute and ask the questions. Huh?
Again, guys, we are super excited about this project. I mean, before we get out of this, I mean, there's a marathon going in Houston tomorrow. And I want to wish everyone a great run tomorrow. The weather seems perfect for a good marathon. And yeah, she is one of them running here from this group of people. I don't know of others who might be part of that.
Yeah, if there is no questions, I assume everybody got everything what they wanted to know. But please email us or call one of us if you have any
Hey,
questions.
guys, just a
later.
quick question, Harish here. So I
Mhm.
think we did not discuss on any, is there any like minimum distribution or minimum investment or kind of thing, minimum max, whatever?
Yes, it is $25,000. It is mentioned in that link. It was also in one of the page, but it's a $25,000. If anybody want to invest less than that,
And
please
again,
contact us. It will not be directly through this, but there are a couple of our friends who are
so
trying to raise money in the group.
is it like shares of 25 or is it like you can put like 40, 30 kind of thing?
So you
Anything before 25,
minimum is 25. After that, it's in the multiple of 1,000.
multiple of thousands. Okay.
Yes.
Thank you.
All right. So thank you, everyone. So I
Thank you,
disconnect.
Agendas. Thanks a lot.
Thank you.